Sanjib Pattnaik. I welcome all of you to this particular session that we shall be having over the next 1 hour. Now, in this particular session, we will be dealing with a particular subject that has been coded as MMPF007, that is equity markets. Now, when we have picked up this course, there we saw what we understand by market, what are the categorization of the market, what are the Indian scenario, what is a primary market and what is a secondary market. Then we went on to see who are the participants in the market. Not only that, we also saw about the regulatory authorities like SEBI, that is Securities and Exchange Board of India, etc. So, apart from that, we went on to see how we can judge a particular investment avenue, or focusing here is the securities, the equity shares. Now, for that, we had two kind of thoughts or philosophies. One was fundamental analysis, and second was the technical analysis. Fundamental analysis tried to tell us what should be the price of a particular security by assessing the fundamentals. In other words, the earnings, the future expansion plans, the management. That means the basic foundations of the organization on which it has built up. So, taking that, we saw the EIC framework, the economy, industry, as well as the company. Then we tried to determine what should be the intrinsic value of a particular security. That is the true value. We take that value and compare that with the market price. If market price was higher than the intrinsic price or the true value of this security that we have determined, then we say the security is overpriced. That means we shall sell those securities before the market corrects the price to its true value. Same we can say about the reverse situation. We try to buy the securities when the securities are undervalued before the market corrects itself. Now, this is one school of thought. Second school of thought says that the market swings or sways according to sentiments. Now, those sentiments are reflected by the past information. If we analyze it carefully, then we'll get various kind of patterns of the market. That means we can assess whether the market will go upwards or it will come downwards. Similarly, the security price, whether it will go upwards or it will come downwards. So, here the school of thought was called as the technical analysis. Here we use various techniques like the pictorial representations or the graphs, charts in the form of line diagram or line graph or the bar chart, etc. Apart from that, we also take the help of candlesticks, which is a thing that has come out of Japan and it is widely being used nowadays worldwide. And this technical analysis tries to tell us what is the time to buy or sell the securities. So, fundamental says which one to buy or which one to sell. The technical analysis says which one we should or at what time we should carry out the transaction. Now, apart from this, we went on to see something called as portfolio. When we are talking of portfolio, what does that portfolio mean to us? Now, from the common phrase that we have, don't put all your eggs in a single basket. It means if your basket falls down, all the eggs will be broken. That means you will suffer total damage. So if I put all my investable amount or the funds that I have in a particular security, and the particular security the company faces losses, then what will happen? Now all the loss I have to bear. So in order to reduce this loss, what I shall do, I shall try to spread over my investment not only in a single security but in two or more securities, so that what will happen? Now if one security gives me losses, another security may be there where I have invested some of my investable amount, that will be giving me profit, thereby negating the amount of losses or minimizing the losses. So, this investing in two or more securities is called as the portfolio. Now, again, went on to see which portfolio will be suitable for us. Now, for that, we use the indifference curve, which showed the satisfaction level of the investors. Now, satisfaction curves are shown through the indifference curves, and the portfolios are represented on a risk return space on a graph by an optimal frontier or efficient frontier. One can visit our previous sessions where we have discussed about the efficient frontier and the indifference curves and how to select a optimal or the best portfolio for an investor. So the point of tangency between the optimal portfolio and one of the indifference curve of an investor is that portfolio which is optimal for that investor, that we have seen. Then we also saw, apart from the portfolio creation, we saw about, apart from securities, are there any other avenues where we can invest our money as small time investors or households who have, in comparison to big financial institutions or large commercial houses, very small amount to be invested, and which forms a hindrance in participating the investment in various kind of securities or highly demanded securities. What are the ways out? Now we saw the way out through mutual funds, where mutual fund act as an intermediary. What they do? They collect or mobilize funds from these households or the small time investors, and this collection makes a huge pool of amount to be invested in various securities of the stock market, be it high priced, be it in more demand, or which has growth potential. So thereby what will happen? Now through expert managers, efficient managers of the mutual fund, we generate returns. And that return is divided among the investors from where we have pulled up our money in a proportionate manner. So mutual fund try to do this. Apart from that, if you have more investable funds, you can also take part in some of the other avenues like real estate investment, we can go for investment securities. We can also go for venture capital funding securities. Venture capital means funding the new ideas, innovations, etc., which are yet to grasp the market. They are now in a nascent stage, but we find many products, many outputs which have been developed over the years. Many fail, but those which are clicking, or that means they are able to hold a grasp over the market, then they thrive in the market. So, in the initial stages, people try to say that since return is not guaranteed, so they don't come forward to invest in these companies where new ideas are being produced and sent to the market. So, their venture capital funding securities help the companies out, and if you try to invest there, then you can have your returns if the venture capital is successful. Apart from that, you can also participate in the stocks which have been selected to create an index of the stock market through index, or we can say the index linked schemes of various mutual funds in general. Now, apart from knowing these basics, the operational parts, etc., now comes the major thing. What is that major thing? Now, we know each individual is different from each other. Just like our fingerprints or retina, each human being is different from another. So their thinking process may be different from the other person or the next person. Why next person? Even if from his family members also. So the thought process also differs according to individual. So when thought process is differing and we are talking about investment, then investment patterns will also be differing from person to persons. Now, what in general are the investment styles that we shall discuss in this particular session? Along with that, we shall also discuss about the trading strategies that are adopted by various investors. So let us go into the thing. We have a three-stage structure here. We start with philosophies, then we move on to styles, then we go for strategies. All of us can see investment philosophies, which leads to investment styles, which guides the trading strategies. Now, what are investment philosophies? These are nothing but the principles and beliefs that guide an investor's approach to the market. So you can say belief of each individual investor will be differing from each other. So investment philosophies is the path that leads for the or towards the market. Then comes the investment styles. What are these? Now, the characteristics or methods used to implement the philosophies. And finally, once we know the philosophies and we have settled down on style, we go to trading strategies. These are the techniques or methodologies used to execute short term buy or sell decisions. This trading strategy will tell us how to buy or sell or how to take decisions. Now, all these three, that is, philosophies, styles, and trading strategies, are interconnected elements for a investor that work together to shape the investor's overall approach to the market. Let us begin with investment philosophies. Now, when we are talking of philosophies or the beliefs that we have, it is nothing but approach or belief system that shapes investors' perspectives and guides their investment decisions. So, the school of thought on which the investor is relying more is the philosophy of that particular investor. This lays the foundation for portfolio construction, and it helps investors to align their strategies with their goals, risk tolerance, and market outlook. That means whatever strategy that the investor is going to take, they should be in line with the objective or the goals, how much risk the investor can tolerate, along with what is the general feeling about the market, whether the market in the future will be growing upwards, whether it will be coming down, like this. Some of the common investment philosophies let us look at. First is the fundamental analysis. As we have seen in some previous classes, here also, one investment philosophy is fundamental analysis, where we depend upon certain EIC framework. Now, who are the fundamentalists? Now, those investors or persons who believe that every security price should be determined by its fundamentals. What are the fundamentals? Now, it can be earnings, it can be operations, it can be the management, it can be the capital structure, etc. That means the basic pillars on which the organization is built up. Now, this fundamental analysis tries to judge what should be the intrinsic value of a security. Here we can say this intrinsic value is the true value of a particular security, which we try to generate through this EIC framework. E stands for economy, I stands for the particular industry where the company is located, and C stands for the company's internal matters. When we talk of economic framework, we are talking of the whole economy of the nation as a total. There we talk of the political climate, the interest rates, the GDP, the rules and regulation of the government, etc. Then we look at the industry, particular industry, because the economy is subcategorized or categorized into a number of industry like transportation, like automobile manufacturing, like iron and steel, like pharma industry, etc. So we try to judge the particular industry in which the company is included. Then finally, we boil down to the C, the company framework. There, we try to look at the earnings of the company, the ratio analysis or ratios, which try to tell us what is our intrinsic value of the security. Now, this intrinsic value we compare with market price. Now, if market price is greater than intrinsic value, we say that the security is overpriced. That means the market price will try to correct itself and it will come down till it reaches the intrinsic value. But when the situation is market price is higher than intrinsic value or the overpriced condition, we try to say that sell the security, sell it off because you will get the maximum profit here. Now, if reverse is the case, then it is underpriced. Maybe market has not assessed the company particularly well, the security particularly well, so that market price is less than the true worth. That means it is underpriced. There, it is advised to buy the security because market price will rise once the underpricing condition is known to all. Demand will rise for those securities. So before that, let us buy it. So the first investment philosophy is the fundamental analysis. Second is another school of thought says that don't go by past datas. Past information are only helping us to provide certain trends and frame charts like this. And if we look the trend line, it is moving upwards. Immediately one can say. Now, if the trend line is moving upwards, we try to tell, yes, let us buy today so that we can sell it off next day. Or apart from the charts, etc., we have various kind of indicators. Where suppose we take the moving average. We take two moving averages. One, a 30-day moving average, and another is the 6-day moving average. Now, what we find here, the 6-day moving average is cutting from upwards the 30 days moving average. This gives a signal to sell the securities. The market price of the security is going to fall down. So this point will tell us when to sell. Or similarly, other way around, we can say whether to purchase the security. Now, another school of thought, they try to use various mathematical models, softwares to predict what should be the market trend in the future. So, using various quantitative, that means mathematical models, softwares, etc., they try to catch hold of the market movements and they try to fit in the data that has already happened into the system, and through the models or the softwares developed for this particular area, they can be able to predict what may happen. It may not be true always, but up to some extent it will be correct. So, quantitative investing school of thought or the philosophy says that use mathematical models, techniques, softwares, etc., for investment purpose. Then another philosophy is buy and hold. Buy and hold is for investor who look for long term goals. When we are looking for long term goals, what happens in the short term? You can see this graph. Again, if we redraw the graph, the share price is moving like this. Now, in this period, one may say that the share price is falling. But if I look at the overall trend, it is rising. And if I sell my securities here, I may not be able to get the profit of the rising trend over a long term period. So, what investors do here? They buy the security and hold it for a fair length of time so that the rising price, the gains, the capital gains, they will be able to get it. So, buy and holding philosophy. Another one is the market timing. Just like technical analysis, it will tell us when to buy or when to sell. And this philosophy is based on the sentiments of the market as a whole. We usually have seen that the market will sway even though the fundamentals are good of a company, they may sway according to the market movements in general. The share price may come down of a company whose fundamentals are also strong enough. So, in that case, what we try to do, we try to see what are the sentiments going on in the market and are the sentiments going to change through analysis. If we can try to assess that changing of sentiments properly, then we try to take decisions of buying or selling the securities. These are some of the common investment philosophies that we have in general. Now, when we are talking of philosophies, what are the aspects we take into account? Now, here we think about three things: personal characteristics, financial standing, and beliefs about the market. When we are talking of personal characteristics of any individual investor, you can say patience. How much patient the investor is. If he has or she has patience, then they can adopt the buy and hold philosophy, or they can adopt believe in buy and hold strategy. If they are impatient, they can go for market timing. Another is risk aversion. So when you don't want to take risk, that means avoid the risk or risk aversion, then you should properly judge about the company of which or of whose securities you are going to invest in. That means the fundamental analysis we are taking. Time for decisions. Now, when we take decisions, it differs from person to person regarding the time taken. If the decision time taken are long enough, then we go for buy and hold or holding strategies. Similarly, age factor. Now, once you are of age which is above 60 or 70 and you are more risk averse, then you go for the fundamental analysis. But if you are young, energetic, etc., and want high return by taking high amount of risk, you go for the market timing or the technical analysis. Similarly, another aspect is the financial standing. First is surplus. Now, what is surplus? Now, always suppose an individual, let us look at his this is income, and we know that they have expenses also. So, apart from meeting the expenses, this individual has this particular area as the leftover or his savings, or in other word, the surplus. Now, this surplus amount is channelized towards the deficit ones. Who are the deficit? Another business houses, government, etc. Usually, our surplus is channelized to the deficit entities. Second financial standing we look at is the job security. Now, let us look at the condition here. We have a large surplus here, all of us can see, but the job is not secure. Then, what we can say? Instead of investing the surplus in total, the person might be holding back some amount for his compensation during the job loss. Then, Third thing is investment options. Where shall I invest my money? Are there any investment avenues where I will invest my surplus amount that I have and it will be meeting my the philosophies. So investment options can be in securities, can be in precious metals, in the physical assets, etc. Needs. What is the need of the particular investor? Not every investor has the same kind of need. Some might be having, suppose, ancestral houses, etc. They might not need a house, but some people will be there who might need a house. For that, they will be looking at their surplus amounts. So, need also has to be taken. Many investors they focus on tax saving part. So, investment avenue which provides tax saving are beneficial to the investors who have to pay taxes. The last aspect that we see in philosophies is beliefs about the market. What do I find about the market? What do I see about the market in the future? So, belief can be personal. Through my analysis of various electronic media, newspaper, etc., I may be gathering some knowledge about the market. And I'll be having a gut feeling that the market will be behaving in this format in the future. So, that is my personal belief. And also, we can take advice from experts, those who spend all their times in the analysis of the market. Now, if one does not have investment philosophies as an investor, what will happen? Now, we do not have any kind of clear cut strategy. Whether to buy or sell, which security to buy or sell, at what time to buy or sell, all these strategies are very unclear. Beliefs on proponent or perceived recent success. If you don't have a philosophies, you go by what has happened in the recent past. You try to frame an assessment of the market by yourself or by the words that are spread around, which may trap you. You can become easy prey for pretenders because many a time we have hoax messages that come up. So if we don't have an investment philosophy, concrete investment philosophy, then we can suffer huge losses. And without investment philosophies, we might be transacting more and more, and each transaction will be costing us. So we will be paying higher transaction cost. Not only that, our tax liability will also be higher. Now, if you are not having any investment philosophies, that is also all right, but you will not be lucky every time. Only few persons or very negligible persons are lucky that without a philosophy they can succeed on their investment part. Once we have determined the belief or the investment philosophy, then we try to look at the investment styles. That means what way I am going to work. So, investment styles, first let us look at value investing. We depend upon the value of the security for investment of our investable funds. Intrinsic value. We have seen the true value can be calculated by the fundamental analysis or through expert analysis regarding the company, which will tell us what is the true value, and we can take that to judge about the security that is being sold in the open market. Second is margin of safety. When we are talking of margin of safety, that means how much away we are from losses. For example, let us look at a company. The market price is 50. Now, the true value of the security or intrinsic value of the security is 48. That means what is happening? Market price is higher as compared to the intrinsic value. We say that let us buy it. What is the gap here I am facing? Not 2 rupees. Let us look at another situation. The market price is rupees 50 and the security has an intrinsic value of rupees 42. What is the gap now? Rupees 8. So we say also buy as market price is higher as compared to the intrinsic value. Now see the two situations. Suppose in your assessment of true value or the intrinsic value of the security, you have made some mistakes. Thereby, this intrinsic value is showing as rupees 48. That means this 2 rupees return that you are thinking is having some kind of risk attached with it. Now, the same rupees 8 is also having risk. Now, which one is having lesser risk? Now, this one is having lesser risk. Why? Now, because I have taken a sufficient gap in order to take the decision of buying. So, this gap between the intrinsic value and the market price is called as the margin of safety. The more the gap, the better is the margin of safety. Fundamental analysis. It tells us about the intrinsic value through the economy, industry, and company analysis. Long term perspective. What will happen to the security prices in the long run? Is the company has survived? Has the company survived over a fair length of time? Will it continue forever? Will it go on getting the profits forever? So, those long term perspectives we try to see. Contrarian approach. So, whatever the market thinks, we try to judge the opposite, contrary to certain thing. That means contrary to the market. Next is emphasis on quality. Quality of a security comes from its fundamentals like earnings, like the number of years it is operating, its expansion plans, its future plans, etc. Higher the quality, higher is the value. Patience and discipline. And some of the major players in the world market investment style who depended on value investing are Benjamin Graham and Warren Buffett. Warren Buffett is very well known. He tried to have an investment style of value investing. He tried to analyze in a detailed manner, careful manner, what is the intrinsic value or what is the value of a security. Thereby, he went on to have the decision of buying or selling the security. Similarly, another investment style is growth investing. Now, here in growth investing, we try to see the growth potential of the organization. Whether over the years the company's sales are increasing, the profit levels are increasing, whether new product lines are being added up, whether future expansion, modernization, etc. are there. All these form the part of growth potential, which is a forward-looking analysis. We look at what should be the approach of the company in the future. Here, quality and competitive advantage companies. When we have competitive advantage, definitely we will be having growth. And quality as compared to our competitors, definitely will take towards higher level of sales, etc. Longer investment horizon. If you want growth, that means the amount you shall be getting should have a long investment period. High volatility and risk. Now, when we are judging about the growth, what is the kind of product or services the organization is depending on its profit margins. So, if the products are or the services are subject or exposed to frequent changes, then our earnings may also be impacted. So we say high volatility and risk will always be there. Here they try to focus on market leaders and disruptive innovators. And this can be done through continuous research and monitoring. Some of the major names are Peter Lynch and Philip Fisher. Another investment style is the investor here, they try to invest their amount for a regular income, be it in the form of dividends or be it in the form of interest. Let us think that it is equity share, so it is dividend investing. So they will be looking at regular income. Not only that, whether there is stability and growth in the dividends. When we started our studies of this paper, we said total return is equal to capital gains plus so this investor, when they depend upon the dividend yield or the dividend they are getting, which is a part of total return, then That investment style is called as dividend investing. They also look at whether the dividend they are getting can be reinvested in the company further. Here in US market, we have two kind of uh, companies according to dividend investing. What are they? Now, aristocrats and achievers. Who are the aristocrats? Now, 500 companies with increase in dividend for at least 25 consecutive years. This is these companies should be included in S&P Standard and Poor 500 index. Similarly, achievers, the companies in S&P 500 who are having an increase in dividend for at least 10 consecutive years. Apart from that, we have sectoral and industry consideration and long-term focus. Another style of investment is capitalization investing. Investor here thinks whether to invest in big companies or small size companies. Instead of that, we say large cap, mid cap, small cap. So large cap, according to Association of Mutual Funds in India, AMFI, top 100 companies in terms of market capitalization. Mid cap are those who are standing in the list of market capitalization according to AMFI from 101st to 250th rank. And finally, small cap companies are those who are 251st or below ranked companies. We look at the risk return profile of the companies and also look at the market efficiency and portfolio diversifications. Another way of investment style is sectoral or industry investing. We know that some industry are very lucrative but high amount of risk is involved there, like software industries. But some industry are there or some sectors are there which are stable and they will continue for a unending period, like iron and steel, etc. So here we look at which sector to be selected. Then is there any diversification within the sector? That means suppose iron and steel industry. Is it large cap, medium cap or small cap? And investor here who believe in investment style of sectoral or industry investing, they should always go for sector rotation because some sector may be climbing upwards, some will be coming down, and after a period of time, the sectors which are coming down may increase, and those who are rising may fall down. So we should have a sector rotation. We should look at risk and volatility. Apart from that, we can also have the exchange traded funds of the particular sector or mutual fund schemes of that particular sector which we have selected. We also take the help of fundamental analysis to analyze the sector's future or the potential of the sector. Here, the sectors can be divided into two categories. One are cyclical sector, another is defensive sector. Cyclical sector are those which see a sine curve. That means along with economy, their performance will be increasing or decreasing in cycles. So this cycle depends upon the product line they are producing. This is upward movement, this is downward, or this may be influenced by the policies, regulation, etc. Similarly, defensive sectors are those where you will find more or less their demand will be stable or will be increasing at a stable rate. They are not affected or sensitive to the fluctuations according to regulations or the market conditions. Another investment style is active and passive investing. What is active investing? Now, as an investor, I will be on a constant uh, process of monitoring the securities that I have included in my portfolio, as well as wherever I have invested my amount, what are the basic fundamentals of that I shall be assessing on a continuous basis. And accordingly, I'll be taking decisions. Passive investing are those who simply invest, suppose in a exchange traded or index linked fund, and sit down. How whatever the way the index is behaving, they will go accordingly. Now, investment style, while choosing it, we shall take this into account. Define investment goals. Assess the risk tolerance, time horizon of your investment period. Look at various investment styles. As we have seen just now, various investment styles are there. Try to focus on those styles, which style the investor is belonging. So, for that, we have to consider the personal preferences and we can also take the professional advice. Diversify the portfolio and always be in constant research process. That means monitor the portfolio and adjust or make necessary corrections accordingly. When we have gone through the philosophies and the investment styles, now we boil down to the actual trading strategies. First is trend following. We try to go according to the market swing. Another is breakout trading. We have seen in technical analysis support and resistance level. If the price breaks above the resistance level, we take a long position. That means we buy the security at that point of time. If the price breaks below the support level, we take a short position. That means sell the securities. Similarly, we take range trading where we try to fix a range within which we do not transact. But if the share prices are moving upwards or downwards, then we go for trading. We have mean reversion, scalping, and technical indicators. And sometimes any kind of event, be it political, worldwide, etc., or natural event, that also forms our trading strategy. Some of the famous investors that we have over period of time who have adopted some kind of styles, investment styles, value investing. We have Warren Buffett, Benjamin Graham. In India, we have Rakesh Jhunjhunwala, Radhakrishnan Damani. Similarly, in growth investing, we have Peter Lynch, index investing, John Bogle, activist investing, Carl Icahn, Contrarian, that means they will be thinking opposite of the market, an Indian, Ramesh Damani. And taking the help of small cap investing is Vijay Kedia from India. Now, with all this, we try to end up our session now. Thank you.